First of all, let me say, I think these probabilities of a future Fed hike have gone down too much. I'm still in the camp to think there's going to be 4 hikes this year altogether, each quarter. And I think the Friday jobs market picture is going to be very, very important. I mean, we can't keep on producing 200,000 jobs a month because the population does not provide that. That lowers the unemployment rate. I mean, we got the beige book out saying
exactly.
there
Professor,
is
on that
tightness
note,
in the labor market. There is going to be some wage increases.
Right.
So I'm not as, so to speak, bullish on interest rates staying low. I think they went down too much in the last 3 or 4 days.
Let me ask you about the beige book, because it goes to the exact point you're trying to make here. So they cite shortages of qualified workers across the country in industries like truck driving, sales, carpentry, electricians, painters, IT workers. But it says that wage hikes remained modest. So I agree with you.
Yes.
If you just looked at the shortages and the hiring going on, you'd think the Federal Reserve needs to keep raising rates quickly, but then everybody keeps saying, well, wait a minute, there's no real wage inflation and broader inflation out there. Do you agree?
I think there is. I mean, the wage data we get with the payroll report isn't as important as, let's say, the wage data we get with the employment cost index, which comes out quarterly, which includes all benefits as well as salary and wage compensation. And that definitely has shown an increase. People are able to dictate terms like truckers. We hear they're able to name their price and their terms. There's a shortage, over 200,000 of them. We heard about airline pilots. My God, when has that happened last? There was always a surplus with the cutbacks of the airlines. That is another labor group that's getting tighter. So it's going to take some time. When we take a look at benefits, I do think we're going to see it. I think the Fed's going to see it. And they're going to say, hey, you know, we still have to move at a moderate pace against these hikes. So we'll wait and see whether this optimism is only going to be 3 hikes or even less, as some people say, whether that can persist or not.
Professor, even if there do end up being more Fed rate hikes than perhaps people have priced in over the last couple of days, what about ECB rate hikes as to when they actually arrive? And to what extent are European bond yields influencing the yield curve in the U.S.?
Well, you know, I used to say that Europe was 2 years behind in terms of the cycle because they had their crisis in 11. We had our crisis in 09, and Draghi is toward the end of quantitative easing where we were 2 years ago. Now, this Italy problem may have put them back another year or 6 months, depending on how that plays out with Draghi tightening. Now, I do believe that quantitative easing is going to end at the end of the year because I don't think that Italy is going to try to leave the euro and break out. But it won't be until 2019 before they're going to begin to raise rates. They are really, but we're ahead of Japan. We're ahead of Europe. We're on the front runner of the recovery. So I don't think Europe's rates are going to directly affect ours.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.